Good afternoon and a warm welcome for the reverse mortgage learning participants. I love this program. I think it's fantastic, and I'm pretty negative person when it comes to anything I don't like. I'm Cindy Bishop with Cindy Bishop Worldwide. It's a pleasure to introduce our esteemed master instructor for today, Kelly Katalinas. Now, let's turn our attention to Kelly. We're not talking about CE credits. She is a seasoned mortgage loan officer with over 3 decades of experience. Kelly has not only excelled in her career, but has also become a leading lender and branch manager. Her expertise extends to training agents and lenders, enhancing production, and cultivating lead generation. That reminds me, boy, we need to get you on the books for some business building stuff because you're really super good at it. In recognition of her outstanding contributions, Kelly has been honored to receive the Lifetime Achievement Award by the Washingtonian Magazine. Additionally, she has received the 5-Star Professional Award for the 4th straight year, which was bestowed upon only 3 out of 4,600 individuals in the Washington, D.C. area in 2024. These are just some of the many professional accolades and awards that Kelly has received. What truly sets Kelly apart is a trust and admiration she's earned from her clients and agents and me, with over 95% of her business coming from referrals. Today, Kelly will share her expertise on reverse mortgages. Without further ado, please join me in extending a warm welcome to Kelly.
Thank you. You always make me feel good with that. I appreciate it so much. Appreciate the warm welcome. So happy to have everybody here. I am going to go through the presentation, and if you have any questions as we go through, just unmute. We don't have that large of a group today in terms of stopping. So if you have a question, you can put it in the chat. I'll try to monitor that as well, or just unmute and ask a question. So I think you're going to learn some things today. I think this is an eye-opener of a program. I added it to my portfolio of programs about 2 years ago. And I really strongly believe that it has multiple uses as you approach retirement age and beyond. Okay, so let's get into this. We're going to talk about reverse mortgages from a top level down. What are they? How does it work? Who is it designed for? What do the loan qualifications and options look like? How you can use it. There are different methodologies you can use. What triggers a loan maturity on this reverse mortgages, and why Fairway I'm not going to spend a ton of time on, but we'll go through all of this. So let's just go through the introduction here, right? And as I asked before we started, what's your opinion of reverse mortgages, right? And we had one raise hands. I heard a lot of negative things about it, but I want to learn more, right? And that's not uncommon, because when they were first introduced in 1989, there weren't the level of protections for the elder community that you have now. And the reverse mortgage that I am going to focus on today is the one that is insured through the Federal Housing Authority. It is an FHA loan. It is a home equity conversion mortgage. So that is going to be my focus, because that is about 95% of all reverse mortgages that are done in the United States today. Why wouldn't you get a reverse mortgage, right? Well, Dr. Fow writes books about the uses of a reverse mortgage. And when you use it strategically in your retirement planning, it can greatly improve the sustainability of your retirement income, right? So it's about thinking about your property as a strategic tool, not necessarily your home. It's that too, but it can be a strategic tool in how you maintain and sustain your wealth in retirement. Most Americans are afraid of living beyond their means, right? The number one fear when you go back to operating on a budget, right? When you might not have been on a budget so strategically your whole life, now you're on pension, you're on a budget, and you're worried about outliving your resources, okay? So we're going to talk a little bit about the uses of the reverse mortgage and how it can extend and sustain your nest egg, basically. If you're 62 or older and concerned about market volatility and inflation, right? So if your dollars are sitting in a savings account, if inflation rises, the value of that dollar decreases. Inflation happens no matter what, okay? Costs of goods and services increase, and you're paying more for the same things over time, right? So how do we deal with that? Are you concerned about, again, outliving your savings? What about making monthly mortgage payments in retirement? You want to retire, but you've got this mortgage you've got to pay. How does this work, right? If you have a lot of equity in the property, and you want to be able to continue to live in your home. Maybe you just want to age in place. You don't want to downsize. You like your home. Maybe it's a family gathering place, but you're concerned about aging. You're concerned about, is it wheelchair accessible? Are steps too much? Like, can this home be valuable to you to stay in as you age? Okay. So just the possible things, these are some of the things we hear people are concerned about. Um, the reverse mortgage loan is exclusively for older adults, age 62 or older. Okay. It converts a percentage of the equity in your home into tax-free cash. You do not have to make your monthly principal and interest payments on a reverse mortgage. You do have to continue to pay your property taxes and insurance, which are not escrowed on a reverse mortgage. You're paying those separately. All right. So I want you to think about how your credit cards work. If you were going to charge every month on a credit card and not make a payment, right? That balance would continue to grow over time. But could you decide to make a payment against it? Absolutely. If you did that, would you be able to reuse that line of credit back up to where your limit was? Absolutely. It's the same principle on a reverse mortgage attached to your property. So as I mentioned, we're going to talk about the HECM, the home equity conversion mortgage. It's the most used reverse mortgage in the US. It launched in '89, but has had so many amendments to it, improving all of the consumer protections. It is the only reverse mortgage that is insured by the Federal Housing Administration. We're going to talk about the value of that mortgage insurance premium on a reverse mortgage. And again, age 62 or older would be eligible for this program. So aren't reverse mortgages just a loan of last resort? So we get this quite a lot. People will say, mom and dad want to age in place. They've run through all of their savings, but they want to stay in their home and they own their home free and clear. Okay. That might be the option of last resort, to put a reverse mortgage on that property and have them remain in the home, right? But I would argue that strategically placed, it doesn't have to be the loan of last resort. It can be a wealth multiplier in your retirement earnings, and we're going to go through that. So primary reasons to get one is obviously need, right? In my mother's case, my father had passed away. All they had was Social Security, reduced Social Security for my mother, who's in fabulous shape at the age of 93, wants to remain in her home, never had a mortgage on the property. How do we do this, right? And improve her cash flow each month. And she's been receiving a deposit every month since 2009 and will continue to receive that until she vacates the property or passes away. You can use it to pay for things that are not in your budget, like travel. Maybe you want to gift your grandchildren or children, you want to help them buy a house, and you don't want to take out a loan to do that, or take assets out of a mutual fund or retirement fund to do that. You can use it that way. You can also use this to maximize your monthly cash flow, reduce taxes, and minimize risks. Okay, now again, we are not tax people, it's not tax advice. But when you think about a reverse mortgage, if you set it up where it's a tenured payment and you're getting a monthly stipend each month, that is non-taxable. So as opposed to pulling assets out of an account that you would have to pay taxes on for any gains you've made, you could use a reverse mortgage to pull that monthly stipend out and not have a tax consequence. So you can really kind of play the game as to which one you would be pulling assets from. So pros, it is a source of cash flow. There's no monthly mortgage payments. Again, you still have to pay the property taxes and insurance and keep the home maintained. And it's a non-recourse loan. And I'm going to explain non-recourse as we go through, okay? The cons are it's only for those age 62 or older with significant equity in their home, or they want to downsize and buy a home using a reverse mortgage and have no monthly principal and interest payments on that new home. So instead of paying 100% cash to downsize and taking all the proceeds out of the house and buy their retirement home with cash, they could leave a portion of that money in a retirement account and growing and working for them over here and have a small mortgage on the new home that they don't have to make principal and interest payments on. Okay. The cons obviously is that it's negatively amortizing. The balance is growing over time. So it's chipping away at home equity over time. Okay. And it has to be your primary residence. This is not a program that is available on any second home or investment property. It is your primary residence. Okay, a couple of myths. The bank will own my home. Okay, absolutely not. The consumer is on title just like they are on any other mortgage. They are the only ones on title. The bank is not on title with them. The owner still has the ability to sell the home or do whatever they want with the home without prior approval from the bank. Okay. My heirs will be stuck with a big bill. Okay. So you or your heirs will never owe more than the value of the home after the loan matures and the home is sold. So let me repeat that. A non-recourse loan means that the home will always satisfy the mortgage balance on the loan, regardless if the value of the home is less than what is owed on the mortgage. Okay, let me say that again. You have a property valued at 400. The last borrower has passed away or moved permanently out of the property. They owe 450. The owner can give that home back to the bank, and the delta of what's owed is not their responsibility nor the responsibility of the heirs. That's what the monthly mortgage insurance pays for. If you have that gap between value and what is owed, right? The mortgage insurance will always cover that gap. Okay. You have to own your home free and clear to qualify. You don't have to own your home free and clear to qualify, but you have to have sufficient equity in the property to be eligible for a reverse mortgage. And that, depending upon age and other factors, is between 50 and 60% worth of equity. If you are age 62, you want to figure your reverse mortgage is going to be about 40% of the value of the home. Okay. So significant equity is needed here. So let's just talk a little bit about loan qualifications. As I mentioned, 62 or older, you are the homeowner, have significant equity, primary residence, and you have to meet minimum credit and income requirements. So it's not the same full documentation loan as you would see in some other programs. However, we will document pension earnings. We will pull a credit report. We place a lot of emphasis on credit worthiness and how you made your mortgage payments in the last 24 months. And any credit card debts, there should be no lates in the last 24 months. So there's a little bit more strict look on this because the balance is growing over time, right? But they're looking to be sure you have enough income coming in to afford the property insurance, the property taxes, and the minimum level needed for basic subsistence like utilities and food, right? So there's like a chart. If it's a family of two, we've got to have this much left over after we deduct out debts, taxes, insurance, etc., for basic subsistence levels for the borrowers. Okay. All right. So it's not like debt to income ratios or anything like that. It's literally cash flow. We're looking at cash flow. Types of property that are eligible are single family homes, 2 to 4 unit properties if the borrower is living in one of them. Townhomes, FHA approved condos. Some condo units, if they're not FHA approved, we might be able to get them approved for this as a single unit approval. Planned unit developments, modular homes, and manufactured homes that meet FHA requirements. So again, as I mentioned, you need about 50% home equity. I would say 60% if you're, closer to the 62 age limit. It gives you an idea of, what kind of loan, and we're going to look at this in a second as an example. All right. So the amount you can get depends on the age of the youngest borrower or non-borrowing spouse. So sometimes we have a borrower who's 62 and the non-borrowing spouse might be 59, right? Or you have one that's 65 and one that's 62, but the spouse doesn't want to go on the loan, right? You still have to base the amount of the reverse mortgage on 62. It's the lower, okay? The interest rates improve, you get more money. Higher the interest rate, the more restrictive the loan balance is going to be. But the maximum amount of money can go as high as 1,089,300. That is the FHA high balance limit across the country for a reverse mortgage. So for high wealth borrowers, let's say they have homes valued at 2 million and they want to retire and they might owe 900,000 on their current mortgage, they could possibly get a reverse mortgage, on their home up to that 1,089,300, because they've got 50% equity, etc. So it's really versatile there. And then this is a chart that kind of gives you an idea of how much you could get at various ages. So for example, the youngest borrower's age is 74. So you go to the age and you go down to the middle. Let's say the expected interest rate was 5.5%. So we go out to 5.5%, and there's a factor there, right, of 45.8. So what they do is they take the value of the home at 600, multiply it by the 45.8, and the available loan that borrower could get on a reverse would be 274,800. Okay. So how could you use that money, right? Well, let's look at your wealth and how to assess this and what makes sense, right? So we know from years 18 to 62, you're working, you've got that one bucket of wealth. It's your wages, it's your commissions, your business earnings, it's pension, it's Social Security, right? You've got that one bucket. Then you have your nest egg, right? And that could be 5 to 20% maybe that you saved for retirement. It could be your 401ks, your stocks, your bonds, your mutual funds, life insurance, cash values, IRAs, etc. That is your supplemental income, right? We know when you get to 62 and you decide to retire, your earned income is going to decrease, right? Because you're going to stop working. So you're looking at your supplemental and what's that going to provide in a monthly distribution or stipend. And then your last bucket in the traditional mindset is the equity in your home that you're not having work for you. Okay. It might be growing, appreciation levels are great, but it's not working for you. It's sitting there, right? For you to give away if you retire, if you sell, or uh, if you pass away, then you're leaving your home to your heirs or whatever, and they're going to sell it, do whatever, and take the proceeds out. Okay, so that but last bucket is your home and your real estate equity. Okay, so now you're going to change your mindset a little bit. If you look at a reverse mortgage and you look at the proceeds we just talked about, first and foremost, when we approve you for a maximum loan amount, not all of those proceeds are available in the first 12 months. There's a limitation. And the reason there's a limitation is years ago, when reverse mortgages came out as a loan of last resort, mostly is how it was marketed. People would apply for a reverse mortgage. They would get all of the money, and then they would stop paying their taxes and insurance, and the property would go into foreclosure and default. In the meantime, the borrower got all the money and walked away from the property, and the bank is left, right, holding it. So they did it a little differently. There's an amount out of that principal loan amount that they can get. Typically 60% of what they're approved for is what they can get in the first 12 months. And then in month 13, the rest of that line opens up and they can get the rest. Okay. So how can they get their proceeds? They can do a single lump sum disbursement. They can do fixed monthly advances like a tenured payment. They can do nothing. They can just set it up and write checks against it as a line of credit, like you would on any other line of credit, only you don't have to make payments on this one. Or they could do a combination of the two. So like, for example, when my mother took out the reverse mortgage in 2009, she said, I really want to put a new roof on the garage and on my house. So we did a lump sum distribution so she could put the roof, she has a freestanding garage, on the house and on the garage. And then she said, I want this much per month. And she has been getting that since 2009. Okay. So you could do it as a combination of the two. So the advantages of the line of credit are that any unused portion of the line of credit will continue to grow over time, right? It grows at the same compounding rate as the loan balance. Okay, so as the balance grows over time, it grows, it grows, it grows. Let's say it started out at 100,000. In year 2, it's at 125. In year 3, your balance 150, whatever. Okay. If you decided to make a lump sum payment against it in year 3, your line of credit would still be 150,000. And you could reuse it back up to that 150. Okay, so it never goes back. It never decreases. It can only increase over time. It doesn't have that provision like some of these banks did a few years ago that said, hey, we don't know where real estate's going. We're not doing lines of credit anymore. And by the way, that $100,000 line of credit we approved you for is now being reduced to 75. Okay, doesn't work like that on a reverse. It'll never go back. It'll never go down. It can only go up. It's secure. It can't be capped. It can't be frozen, and it can't be eliminated due to market conditions, as I just mentioned. And it's liquid. You know, the unused portion of it can be borrowed against, you can pay it back, and you can borrow again. So I have a realtor friend who is on a reverse mortgage and absolutely uses it strategically. So they say, Kelly, I never know what the year is going to bring me in terms of commissions in real estate. I'm working hard. I could expect a certain amount, but I never really know. So what I do is I don't make my mortgage payments on my reverse mortgage all the way to November. Okay. In November, I decide if I want to take some of my assets or wages or commissions and apply that to my mortgage balance, because maybe I just don't want that loan to be too big. I want to monitor it. Maybe I want to keep my assets working with my financial planner, right? If the reverse mortgage interest rate is 6.5 and my financial planner keeping my assets over here is making me 12, I think by November, I'm going to decide if I want to pull a little bit of those gains and apply it to this mortgage or not. But at least I don't have the burden of ups and downs in commissions with having to make that mortgage payment. So strategically, they're looking at it. I'll make that decision by November. Now, why do I say November? Well, if you're going to pay your mortgage, you want to be sure that the lender has that before the end of the year so they could issue you your 1098 interest statement for your tax return. Okay. So again, think of the flexibility, right? In the end, whoever has the most money wins. If you're paying 6.5, or you're paying 5.5, or you're paying 7, but keeping your money over here is making you 12 or 10 or whatever, okay? Working with your financial planner would be smart to figure out, how do I end up, over time with this? And it's just, again, it's a huge financial tool. I think once you see the power of it, you'll start looking at your house a little differently. So again, this just tells you how the line of credit grows over time. For the 62-year-old borrower, if the current home is worth 600,000 and the available line of credit today was 223,506, that same borrower 27 years later would estimated home value would be about 1,024,000, and the line of credit would be 1,026,000. Okay. Huge use over time, huge availability to access it over time, pay it back or access it. So just think of the versatility there that you could have. You can use a reverse mortgage to just extinguish payments on your current forward mortgage, right? You want to replace the loan you have that you are required to make payments on with a reverse mortgage. Again, you still have to make your property taxes and insurance separately. And that line of credit is a standby for your portfolio protection, right? You could use a reverse mortgage to enhance your cash flow in down economic times. As I mentioned, in the real estate market, nobody had the best year last year. Some did, some didn't, but a reverse mortgage could kind of fill that gap. The other thing is it can be used if you're not ready to start taking your Social Security distributions. You could use this as a gap, right? To wait out the time where you get more on a monthly basis. So for example, my full Social Security benefits at my age, I'm 61, will start at 67. Okay. So I could say, you know what, I don't want to work till I'm 67. Maybe I'm going to retire at 65, or I'm going to retire at 63, but not start drawing Social Security to 60 until I'm 67, at which time I get the maximum monthly amount I could get. And maybe I just use my reverse mortgage as an interim cash flow tool to get me through those years. Okay, so a lot of people consider it like, why wait to retire kind of thing. Okay, if you really had it in your mind to retire at 65 and the needle keeps moving. Okay. You can increase your cash flow, again, the retirement income gap, get the most lifetime value from Social Security, as I talked about. You can help your family, you can donate, you can use it, as I said, a wealth multiplier to pass along a nest egg to your next generations. You could use it to renovate your home. You could use it for in-home care. If you've got nursing care coming in or assisted living coming in, you don't want to leave your home. Long-term care insurance premiums. Okay, that's a big thing, and it's not inexpensive. It's very expensive. Average cost of long-term care, home health care for Alzheimer's, meal prep, whatever, is about $60,000 annually. Assisted living facilities, right? Might be 54 on average annually. And then full nursing home care could be as much, if it's private, could be as much as 108,000. So think about how much that is on a monthly basis, for nursing home care. So Medicaid is only going to pay for shared rooms. And again, 95% of people have no long-term care insurance, and over 50% will need them. So again, it could help you keep your adjusted gross income low, because any funds you take out of your reverse mortgage are not considered income. It is not taxed. It's a hedge against market risk. It will insure against longevity or pay for long-term care. And again, it can maximize your other retirement contributions. So again, it just lets you know a few things about home equity as it weighs into retirement income strategy. So why would you set this up at age 62 instead of 82, right? Well, if you open it early, 78% cash flow survival rate of your retirement benefits, okay? You'll have a 78% cash flow survival rate. Okay, and it's based on a 32-year investment return, meaning you're going to live until you're 94 in the way that they estimate this. If you delay it and you open it later, and it's your last resort option, okay? If you delay opening until your other portfolio money is depleted, your cash flow survival rate dropped from 78% down to 60%. Still good, but not as good as 78%, right? And then if you ignore it altogether, you know what? You just can't think. I paid off my house. I just cannot think of putting a mortgage back on my home no matter what. It just goes against the grain. I'm proud of that. I got rid of that mortgage. But if you ignore the home equity altogether, your post-tax initial withdrawal rate, cash flow survival drops to 35%. You got to do something at some point when you run out of money and you're still healthy, right? To live there. This just teaches you kind of how to think differently about the equity. Again, this is just a visual of what we just talked about, and how the line of credit grows over time, and you have access to that. It has the top consumer protections. We are very concerned about elder abuse. So when I get someone who's interested in a reverse mortgage, I typically have a phone interview with them. I go through a questionnaire. I get the pertinent information, and my team will prepare a proposal for them. It's a big proposal. It's very detailed in numbers. And we go over it together, because this is not something you can just talk about on the phone. You have to be looking at it visually to see how it works and does it make sense for what you're trying to achieve. Once you as the customer says, I think this is a good fit for me, then I would get a HUD approved counselor out to you. They come to your home, they spend time with you, they answer any questions you or your borrowers would have. They talk about strategy and what you can and can't do with this. Okay, so believe me, there's a lot of protection here. They want to be sure you know what you're signing on for. Okay, they talk about the initial disbursement limits. They do a financial assessment, which we do that. It has non-borrowing spouse protections, meaning that, let's say at the time, let's say the reverse was done in one borrower's name, but they were married, but the spouse was not on the reverse mortgage. There are protections for that non-borrowing spouse to remain in the property after the borrowing spouse passes away or moved out permanently, as long as they're still married. Okay. The line of credit is secure. The unused line of credit grows regardless of the home value. And again, that non-recourse feature, as I discussed earlier, means the house will always satisfy the loan. Always, regardless of if there's a gap between what's owed and what it's worth. You can use this to buy a home. It is very popular for people that are looking to downsize or upsize or right size, whatever they want to do. Instead of paying 100% cash for the next home, they put down somewhere between 45 and 65% based on their age and the actuarial tables. And they can keep more of those assets working for them over here in their retirement fund or for rainy day or for whatever lifestyle enhancement. Okay. So it's just, we definitely can do it on a purchase transaction. Proprietary reverse mortgages are also available. I don't spend a lot of time on this, but there are reverse mortgages that are not insured by the Federal Housing Authority. And people in very high cost areas, maybe their loan amounts are over $1 million, they're 2 million, and they want to do a reverse mortgage. There are banks out there that have reverse mortgages designed for higher loan amounts, designed for people under the age of 62, or if they're in a non-approved condo complex. So we have a couple of those that we can look at too if it doesn't fit into that FHA box. Loan maturity happens. So when does this loan become due and payable? Well, you want to sell your house. Just like any other loan, you've got to, if you sell your house, any liens attached to the property have to be paid off. Okay. If you decide to transfer the title to someone else, the note is due. The last surviving borrower moves out of it permanently, the note is due. If you default, if you stop paying your property taxes and insurance, just like if you stopped paying your property taxes and insurance on your current loan now, that's a foreclosure. Okay, you're going to get liens and that home is going to move into foreclosure as a result. Okay, same different, nothing special here, same exact thing. You default on the loan terms or the last surviving borrower passes away. Okay. So what happens then, right? How is this balance repaid? Well, if the loan is not yet due and payable, the borrower who has the reverse mortgage can either pay against it or not. It's up to them, just like a line of credit. I want to pay against it. I want to keep the balance a certain amount, or I don't. Okay. They can make no monthly payments at all, or they could pay as little or as much as they want. There's no prepayment penalty. But once that maturity event happens that we just discussed on the previous slide, the loan is due and payable. Okay. As I mentioned, the sale of the home will always satisfy the loan repayment obligation, and the borrower or the heirs will not be personally liable for any balance deficiency. But what happens if the kids want the house? Okay, so let's say we've got this grid, right? Do the heirs want to keep the home? Is there any equity left? So let's say yes, they want to pay off or refinance the loan balance. They could do that, right? If there's no equity left in the house, but the kids still want it, they want to keep it in the family, the heirs can purchase the property with a short payoff of 95% of the appraised value. So again, go back to our example. They owe $450. The house is worth $400. the kids could purchase the home for 95% of 400. Okay. If there is equity left in the property and the heirs, want to keep, don't necessarily want the house, they can sell the home and pocket those profits, just like any other sale, right? They could walk away or they could try to sell it and get that money. But if there's no equity left in the house and the heirs don't want it, they literally just walk away from it and give it back to the bank. Make sense? So why Fairway? We just talk about, we do more reverse mortgages than any other lender in the country. We are very highly rated in this particular program, but again, we're a full service lender approved in all 50 states. I am really about educating people on the power of this program, because I think when used strategically with your financial planner, you really can think about your home in a different way, think about how you want to live your life in retirement in a different way, and extend those retirement benefits for yourself and your family. I think, there's so many uses here for this, that you might have been thinking, oh, I've got this many years before I can retire. You might want to do this before you retire and just slow down and not retire. There's a lot you can do here. Any questions anybody has?
Yeah, I have a question, Kelly.
Yes.
Okay, so this reverse mortgage, as you mentioned, you protected the interest of there is a spouse, but if this house has been under trust, like if you have a house and you put it for your kids and is under trust and you try to do the reverse mortgage on it later in the future after 62, how that?
Yeah. So it's okay to have your home titled in a trust as long as it's a revocable trust, and we would review those trust documents to be sure it's, that's fine. It's okay to have it in the name of a trust. That's fine. It doesn't preclude you from doing it. Was that the question?
Yes.
Yeah. Yeah, as long as it's a revocable trust, then we would get a copy of the trust documents and do a trust review. And as long as it's fine, you shouldn't have any problem taking it in the name of a trust.
Okay, thank you.
Sure. Any other questions? So think
Yes,
about,
please.
oh, go ahead.
Okay. Is it like 50% of the appraised value of the house you have to have? Like I'm age 72, so is that what
Right.
it is?
So, yeah, so we would run it based on the age and value of the house. And again, if interest rates come down, you get more. Okay. So we would run that based on your age. In general, I would say yes, in general. Okay. It might be between 45 to 50% of the appraised value of the home.
Okay, so it would be like refinance with the reverse mortgage, meaning that there would be different interest rate than what the rate is now.
Yes, this is not a fixed interest rate. This interest rate will change monthly, just like your credit cards change, right? Only it's a much better index, kind of like an adjustable rate index, but it changes monthly. So if you have a mortgage on your current home now and you want to refinance that mortgage, extinguish those payments and replace it with a reverse mortgage, you could do that as long as we have a sufficient amount based on what you qualify for, right? Closing costs on a reverse mortgage are a lot higher than standard transactional costs. Like, so for example, in Virginia, closing costs average on a forward transaction about 2.5% of the price of the home. Reverse mortgage, you want to figure closer to 5%. And the reason for that is there's a 2% mortgage insurance premium that FHA collects up front on the reverse mortgage based on the value of the home. Yeah, so it's higher closing costs on this.
Okay. All right. Thanks for the info.
Very welcome.
I have a question. This is Terry.
Yes.
Okay, when you talked about the 4 different ways that the property could be sold, go back to the if one of the heirs wanted to purchase the property, but appeared to be no equity, they
Right.
could get it for 95% of the balance owed, correct?
No, of the value, of the appraised value.
So it'd have to be appraised.
Right.
And based on the appraised value, meaning
Correct.
they owe 400, but the appraised value is 380.
Right. So think of it this way. They owe 450.
Okay.
The house is worth 400.
Yes.
They could buy it for 380.
Okay, there you go. Almost like a short sale.
Yep.
Okay, and
And they
then
do that as a protection for the heirs in the event they want to keep it in the family. They'll allow that to happen.
and that only has to be that's the heirs. And then selling it outright, versus okay, it's worth 450, pay off the 400, 50 goes to the heirs. Did I say
Yeah,
that
so
correctly?
if it was worth 450 and they
Mm.
owed 400, you would sell
Yes.
that like any other property,
Sure.
right? The
Okay.
profit would go to the heirs. It doesn't
Mhm.
matter what kind of loan is on it because they're going to walk away with money.
With money. All right, that
Only in the
makes
case
sense.
where there's no equity in it. That
Okay.
heirs and everybody doesn't have to worry about making up that delta. It's forgiven.
Right, it is forgiven if there were no equity or was
Correct.
no equity, but if the heirs wanted emotional ties, whatever the case may
Yep.
be, you're satisfying that need or that desire.
Absolutely.
Cool.
Yeah, they're getting it at a discount, right?
And getting it at a discount. Yes.
Right. Right.
I did have that to happen recently, but I didn't know enough to know what I didn't know. And the heirs purchased the reverse or paid off the reverse mortgage. So
Yeah.
I'm assuming maybe they got it at a discount. Then they
Or
fixed it.
yeah, or they just refinanced it or pooled their money, whatever. Now, I will tell you when one of these events happens, the reverse mortgage, when you read the note, will say has to be paid in 30 days. Well, that's almost near impossible. So they typically give you 6 months. Once you say what you want to do with it, they typically give you 6 months to either sell it or sign it over or whatever. And sometimes they will do an additional 6-month extension. Okay, so there is
Yes.
leeway there.
The 2 that I did do over the last 5 years, they actually got the extensions and they had it for a year,
Yep.
Really, they did. They did the 6 month. They followed the little rules, turned in their documentation, and then they had a 3-month extension and another 3-month extension. So depending on how strategic you want to be,
Right.
one young lady what did she do? She just stayed there for a year and then eventually sold it, but that gave her time to go find somewhere to live, whatever.
Yeah, or get the house ready, right?
Yes,
Maybe,
yes.
maybe it needs work before you put it on the market or whatever. But yeah, no, it's got great protections now than it ever did before.
All right, and then one last comment or question. When my client was working through that process, for some reason they were talking to HUD, I believe.
Yep.
Now that seemed for them to be very
Unfortunately, most of these loans are serviced by CompuLink, and they put you right through to the HUD FHA case number line. Like when I look at my mother's bank statement, because believe it or not, she's decided to move in with my sister, God help them both, that we're in the process of getting her house ready to go, this 110-year-old childhood home of mine. But when I look at their mortgage statement and anything that had to be done, it literally is the same servicer. You've got to deal with them. it's over the phone or it's by fax. It's like you can't go online and get into their site and try to get anything done. It's old school. You know
Okay,
what I mean? So just, yeah,
just be ready to go through the process
yeah,
because you will benefit.
you will. It's just a
Okay,
little old school in the way they work because they're assuming an elder population, so everything is in writing or you know, or fact, like they want to be sure there's no elder abuse of any kind. So it's a little bit more traditional in the way they handle it.
okay, sounds good. Thank you.
You're very welcome. Well,
I had a question.
go ahead.
Can I ask you, to clarify, I know one of the slides you were talking about, like the cost of like in-home nursing care or
Yeah.
out. So I was thinking of this in particular for my sister who's 76 and owns her condo outright, and her
Mhm.
daughter was living with her, has been staying there. My sister's in the hospital. Can she get this only if it's in-home, like health aid, or can she use
Mhm.
this if we have to put her in a more like a assisted living?
So she has to live in the house. Okay. If she goes to assisted living and it's beyond a year, she's no longer living in the house. So if she went for short term, like for a rehab,
Mhm.
you could do a reverse mortgage. She could go to rehab and come back. But
Okay.
once 12 months goes by and she's not coming back, the loan is due.
Okay.
Mhm. So
All
it
right.
does allow,
Because my niece could live there, but she's not, that age. She's only 40, so
correct.
she wouldn't
Correct.
be on the, yeah. Okay.
Yeah, she can't, she's not gonna help her going on the note on this. It would have to just be in mom's name to get anything, really. But you know, you've got snowbirds, right? That their primary residence is here. And then they go to a warmer climate 3 or 4 months out of the year. Well, just because they've gone on vacation for 4 months doesn't mean the note is due and payable, right? They're still in a primary residence. So it's only like that assisted living or nursing care, they're going to be permanently out of the house. You've got a decision to make at that point.
Okay. But if she comes back, then you still have your like line of credit or whatever, you can keep it.
Absolutely.
She needs at-home help. Like she has to pay for
Absolutely.
private nursing help or
You
whatever.
could use it
Okay.
any way you want. Correct.
Okay. Mhm.
Mhm.
Okay, thanks. I might have to
Sure.
call you for more, but thank you.
Yeah, my pleasure.
Mm.
Well, thank you, everybody. I know we went a little long today, but great questions. I really appreciate it. I'll get my contact information out to everybody after the call. And if you have any questions, just reach out.
Thanks, Kelly.
All right. Good
Take
seeing
care,
you all.
everybody. Bye.
Take care.
Thank
Bye-bye.
you. Thank you.